Welcome to Iron Financial, where we forge stronger portfolios by cutting through market weakness. Today, we're putting Philip Morris International under the microscope. Now, the company claims it's building a smoke-free future, and frankly, they're posting some massive numbers to back it all up. But you know us, we're here to stress test the very foundation of that claim. We're going to examine the blueprints, check the load-bearing financials, and look for any of those tiny hairline cracks that could bring the whole structure crashing down.
So you just heard the CEO, Jacek Olczak, and you got to admit, the headline numbers, they sound solid, like heavy-gauge steel beams being locked into place. A fifth straight year of volume growth in this industry? That is a statement. $40 billion in revenue, that's a fortress wall. So on the surface, what we're looking at is a picture of immense strength and incredible forward momentum. They are painting an absolute masterpiece of corporate transformation. Hold on now, hold on. Headlines are one thing, and they're great for press releases, but the fine print? That's always another story. We need to look at the actual blueprints before we stand back and admire the skyscraper. So the real question, the one you should be asking, is this. Are they building a solid financial fortress that can withstand a storm, or is this a house of cards just waiting for a strong regulatory wind to blow it all over? See, anyone can put up a good-looking facade, but we're here to see what's really holding it up. So let's get our hands dirty and inspect the work.
Okay, let's dive into this thing. Here's our plan of attack. We are going to systematically break down Philip Morris International's entire structure, piece by piece. We'll start with the big strategic bet they're making. Then we'll hammer on the financials. After that, we'll inspect the new growth engine, stress test their star performer, ZYN, identify all the potential cracks in the armor, and then we'll end with our iron verdict. No stone left unturned.
First things first, we have to understand the core strategy here. PMI isn't just evolving a little bit. No, they are staging a massive, incredibly capital-intensive pivot away from their legacy business. This isn't some gradual shift you read about in a business textbook. This is a deliberate, high-stakes demolition and reconstruction project, and it's all happening in real time. Make no mistake, they are betting the entire company on a future that looks radically different from its past.
And this number right here? This is the capital they have poured into developing smoke-free products just since 2008. Over $16 billion. This isn't some little side project or a pet R&D venture. This is a bet the company transformation. $16 billion is a staggering amount of capital to deploy. It really speaks to the level of conviction that's driving this strategy. Or, it could speak to desperation. Look, $16 billion is a heavy, heavy number. But just spending big doesn't guarantee a win. We need to see if that massive investment is actually building real, durable value, or if it's just funding an incredibly expensive science project. A lot of companies have thrown good money after bad ideas. The key question for us, for any investor, is about the return on that massive investment. Is it generating the kind of cash flow and the kind of market position that actually justifies that enormous price tag?
All right, let's get into the hard numbers. This is the financial bedrock of the whole story. All the strategy, all the investment, it has to translate into sales, or it's just a lot of talk. This is where we find out if that $16 billion foundation can actually support the weight of the company's ambitions.
And here we go, the first test. Net revenues surpassed $40 billion in 2025. That's up 7.3%. That is solid top-line growth. It shows real momentum. Now think about it. In an industry that's facing a secular decline in its core product, any growth at all is notable. But over 7% growth at this scale, that is a powerful indicator that the new strategy is gaining serious traction and that consumers are responding.
And this number right here brilliantly illustrates the impact on the bottom line. Reported diluted earnings per share hit $7.26. That's a massive 60.6% jump from $4.52 in 2024. That is some heavy-duty performance. This kind of earnings acceleration is exactly what gets Wall Street's attention. It suggests powerful operating leverage and serious profitability flowing directly from that top-line growth. It's the kind of number that makes a powerful bull case all by itself. Numbers like that always get my attention, but they also raise my suspicions. I'm looking at this slide and I see a gap. The reported EPS is $7.26, but right next to it, the adjusted EPS is $7.54. So what's the story there, analyst? We need to strip out the noise here. What are these adjusting items and how much do they really matter? The press release mentions things like amortization of intangibles and, various tax impacts. It's absolutely crucial we understand if that 60% growth is pure operational performance or if it's being flattered by a bunch of one-off accounting items. We need to know the true quality of these earnings.
That's a fair question, and this slide right here helps answer it by showing the machinery that's actually driving these numbers. What's really interesting here is that it shows the transition happening in real time. The smoke-free business now accounts for 41.5% of total net revenues. That right there, that is the future of this company. They are rapidly approaching the tipping point where the new business is actually bigger than the old one. This is the visual proof that the $16 billion bet is paying off in real, tangible operational revenue. The future maybe, but today, right now, combustibles are still paying all the bills. They're bringing in nearly 60% of the revenue. They are funding this entire transition. Let's not forget where the heavy lifting is still being done. That $23.8 billion from cigarettes, that's the cash engine that's financing the R&D, that's paying for the marketing for smoke-free products, and it's servicing the nearly $50 billion in debt we're going to get to later. This whole transition is a high-wire act, and the safety net is made of traditional tobacco profits. If that net starts to fray, the whole act is in serious jeopardy.
That's a fair point. A very fair point. So let's inspect that new growth engine. We need to know if it's powerful enough to carry the full weight of the company, especially as that combustible safety net you just mentioned gets smaller and smaller over time. Is this new engine a high-performance V8, or is it straining under the load?
Well, the scale of the smoke-free operation is pretty much undeniable at this point. It's in over 100 markets with 43 million users. This isn't a niche product anymore. This is a global platform. Volume growth of nearly 13% is incredibly strong, and reaching 43 million consumers shows significant market penetration. And look at the profitability. It's generating almost 43% of the company's gross profit. This engine isn't just running, it's generating some serious torque.
And within the heated tobacco space, their flagship product, IQOS, is utterly dominant. It holds roughly 76% of the global category volume share. That's not just a lead, that's a fortress. This is what investors look for, not just participation in a market, but domination of it. A 76% share creates a powerful moat, it builds brand loyalty, and it gives them significant pricing power. It's the kind of market position that is incredibly difficult and outrageously expensive for any competitor to challenge. I get it, a fortress built in one category. But what's the cost? How much of this growth is just cannibalizing their own high-margin cigarette sales versus actually creating new revenue streams? You see, dominating a category that you largely created yourself is impressive, but the real test is expanding the total addressable market and fighting off challengers in newer, hotter categories, like oral nicotine.
All right, let's drill down on that, because you're right, ZYN is the high-octane fuel in this engine, especially in the critical U.S. market. The acquisition of its parent company, Swedish Match, was a massive strategic move. A huge bet, and ZYN was the crown jewel of that entire deal. So now we need to see if it's actually living up to that massive price tag. Just look at that acceleration. ZYN shipment volume in the US jumped over 19% in the fourth quarter alone. That is absolutely explosive growth. This isn't just steady progress. This is a product that is catching fire. A nearly 20% quarterly jump shows intense consumer demand and really successful market execution. This is the kind of hypergrowth that can fundamentally change the valuation of a company this size.
And it's not just about volume, it's about market dominance. A 2/3 value share, that shows they have a premium product with an incredibly powerful brand. This isn't just market share, it's a stranglehold. And they achieved it through a combination of first-mover advantage, aggressive marketing, and a product that just clearly resonates with people. What this really means is they aren't just shipping units, they're commanding higher prices than their competitors, and that flows directly to the bottom line. This combination of high-volume growth and premium pricing, it's the holy grail for any consumer product. But dominance always invites competition. The market knows ZYN is a cash cow, and you can be sure the competition is building its own machinery to take a piece of it. That 2/3 share is a giant glowing target on their back. Every competitor, big and small, is reverse engineering ZYN's success and looking for any weakness they can possibly exploit.
Yeah, and this slide shows you the battle lines being drawn right now. British American Tobacco's VLO is a serious threat, and they are not standing still. Remember those third-quarter investor worries about promotional activity hitting ZYN's profitability? The question is this market share being bought at the expense of margin? It's easy to grow sales if you're practically giving the product away. The real challenge is defending this 2/3 share without sacrificing the premium margins that make the product so attractive in the first place. This right here is the key battle to watch.
Okay, let's address those risks head-on. No structure is perfect. We've seen the strength in the steel beams of their revenue and the concrete of their market share. Now it's time to take out the magnifying glass and look for the stress fractures.
And boy, there are a lot of them. This isn't just one potential crack. This is a whole wall of worry. Any one of these could cause a major structural failure, but that regulatory risk, that feels like the biggest sledgehammer hanging over their entire operation.
I mean, from supply chain issues to lawsuits, the external pressures are immense. But nothing can change the fundamental business model as quickly or as devastatingly as a government regulator with a pen.
Exactly. The whole financial model, the entire $16 billion bet on smoke-free products, is based on them being treated differently than cigarettes. The argument they make is that they are less harmful and therefore should be taxed less and regulated more leniently. But if governments around the world decide to tax them at the same high rates as traditional cigarettes, that entire profitability engine could seize up overnight. The margin advantage would just evaporate, and the whole investment looks a lot less attractive.
And we have to address the financial leverage. This right here is their long-term debt as of the end of 2025, $48.7 billion. It is a massive number, and it was used to fund those big acquisitions like Swedish Match and their ongoing smoke-free product investments. This is the bill for their transformation. $48 billion is a significant structural load. That is a heavy, heavy load to carry, and it makes them vulnerable. You have to ask, can the cash flows service this debt, fund the dividend, and keep investing billions in R&D and marketing, all at the same time? It's a high-wire act. In a stable, low-interest rate environment, maybe it's manageable. But if borrowing costs rise, or if cash flow suddenly falters because of competition or new regulation, this debt load turns from a tool for growth into an anchor that can sink the whole ship.
So, after stress testing the framework, it is time for the verdict. We've weighed the materials, we've examined the structure, we have seen the formidable strength, and we've pointed out the potential vulnerabilities. So, is this an opportunity for investors, or is it a trap?
The bull case is built on a solid foundation of execution. There's no denying it. They're successfully building a new, dominant business with incredibly strong growth metrics and market share in both IQOS and ZYN. The revenue and the EPS growth are undeniable. They have a clear strategy, and they're executing it at scale, all while maintaining pricing power in their legacy business to fund the entire transition. This is a company actively forging its own future. But the bear case sees the external threats. The foundation is strong, sure, but it's built in a hazardous zone. That regulatory risk is the earthquake that could shatter the whole thing. Intense competition from Velo and others is the constant wind erosion, slowly wearing it down. And that mountain of debt is a potential landslide just waiting for a trigger. It's a powerful machine, yes, but it's fragile. And its reliance on the declining combustible business for funding, well, that can't last forever.
Ultimately, the decision rests with you. We've laid out the blueprints, we've highlighted the structural strengths of their new empire, and we have pointed out the potential cracks in the armor. You have the bull case of a dominant market leader that is successfully navigating a massive, historic transition. And you have the bear case of a company facing existential regulatory threats and a very heavy debt burden. Now you have the tools to make the call. That's how you build a stronger portfolio. This is Iron Financial.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.